ARMR Insiders, welcome to the show. Welcome to the morning meeting. Thanks for joining. All right, let's dive right in. Try to keep these conversations to a particular goal, which is what's the information? How do we make money on it? Let's cut out the rest. So trading posture, investing posture, that's what I'm going to share with you. Don't forget, this is my own personal process of how I run my own capital. So it's the ARMR investing way, using our whiteboard as our filing cabinet for all the ideas we want to own, use our algorithms to tell us when to position those investments, and use our stop losses to protect ourselves. So as always, use your own due diligence, your own risk tolerance, and all those things when you make decisions. So let's jump into a picture of the Nasdaq. Okay, top of the channel. Tried to break out of that channel, couldn't do it. Turned risk monitor red 2 days ago, and then yesterday the market was down again a little bit. Now the market's going to be gapping below the low of, not quite yet below the low of yesterday, but going to challenge that low. Okay. The reason for this is that we just had the employment number. Now nobody really cares about, and I mean this sincerely, what the employment number is. The Algos run out there and jerk things around from here, pillar to post sometimes based on a big beat or a big miss. But if you've been doing this as long as I have, you're going to recognize that there's always a big beat and there's always a big miss. The analysts haven't the slightest idea what the government number is going to be, and the government manipulates the number. So, I mean, that's just a fact. So let's just put that aside. So whatever the knee-jerk reaction is to a huge miss or a huge beat on the top line number, it's kind of a total waste of our effort. So what's really important inside of all of these numbers is wage inflation. So we have a Fed talking about inflation concerns and wanting to reduce liquidity and raise rates. So if you look at the top line number, it looks like, oh, geez, a lot less, jobs, a lot less were created than people expected. But then again, the prior month, they increased the number a lot more than it was. So the whole thing's kind of ridiculous. But inside that number, we see wage inflation. And that's why the market went down on the number, because you might have thought the market would go up on the number, right? Because the top line number was less jobs created. So that should be less inflationary. So the Fed won't have to, that's the thought process, right? But the market immediately sold off. And the reason is we see wage inflation. So this is a problem here to stay. So let's talk about how we're going to trade. What's our trading posture? Let's start there. This is very important for you guys in the live trading desk with me to understand what it is I'm trying to do every day when I come in. The ARMR portfolios, 4 of them, right? Index only, 100% cash. It has been really since we exited. I guess that was right in here. We exited right here, and we haven't gotten long again. So that was, I guess, the 3rd of December, we went to cash in that portfolio, and it continues to be in cash. And if the day ends up on the lower end of today, then since December, the market will actually be down. And this is why the index-only portfolio is sitting in cash. So ARMR Portfolio 1's focused on investing in stocks that we love off the whiteboard. We'll get to that in a minute. Portfolio 2 is algorithms. We're coming into the day in both of those portfolios, by the way, with a ton of cash in the portfolio. So let's talk about our trading posture. What I'm looking to do here is capture alpha. These are alpha capturing trades. When we are in a large cash position, I'm talking like probably 75% cash in portfolios right now, and the market goes down at the open, we've got alpha just by having cash. And to harvest that alpha, we need to capture the rally during the day. So that's the trade I'm looking for. In a risk monitor red / negative gamma market, volatility increases. The percentage of profitable trades we're going to have goes down. So out of 10 trades, if we were 8 out of 10 in a risk monitor green positive gamma market, we probably drop down to 6 out of 10 in a risk monitor red negative gamma market simply because the volatility is so fierce. We continue to execute because, first of all, 6 out of 10 can be very profitable because our losses are smaller than our gains. But on top of that, in a negative gamma risk monitor red market, the volatility is so fierce that the payoff when we're right can be enormous. So we keep putting capital to work and we accept the fact that we're going to have some more losses on positions. When I say more losses, we're going to have more positions that are losers, right? Put a trade on, get it off quick. Take a small loss, try to put another trade on. Might have to take it off again quick. The third trade we put on, huge run in the afternoon, pays for the other two by multiples. That's what these types of markets are like. So when the market's gapping down, the first order of business for me is to look for that rally off the low. And what I did this yesterday, and yesterday we really squeezed water from a stone. We made some money day trading, but it was small because there wasn't a lot of movement off of the open. There was the move at the open, and it just kind of traded in that range, small rallies, small sell-offs. We were long, we were short. We were long, we were short. So not a lot to do yesterday because the market didn't really go anywhere, but we captured a little bit. Let's call it a break-even day, though. We made money yesterday, but on days where we lose a little bit of money, I call them break-even. So on a day where I make a little bit of money, I'm calling it break-even to be fair. It's not really a day where we make any real money, which is fine. There's going to be days like that. So on days where there's no real movement, if we can come out that day ahead a little bit, great. We're just biding our time, waiting for the next 3 or 4x move that we can capture. So it could be today. We don't know. The market's going to open up, see how it trades. I'll be looking for a long trade first. And when we're in risk monitor red, in a negative gamma environment, I look for short later. There's usually 2 trades. If we get into a real downtrend, the market really starts to accelerate lower. There'll be 2 and sometimes 3 trades a day. Long, short, long. That can happen sometimes. Or just long and short. What would be long, short, long? Long in the morning off of weakness. It rallies. We book our profit. We get short. It implodes. We get really paid. But then it rips back to the VWAP in the last hour. And we might put that trade on. So we're much more active in this type of environment. Quick thought I wanted to share with you. Volatility has remained in an increased position. I don't want to get too lost in the weeds here, but that's a serious problem for the market. It basically tells you it's a way to express what I've been trying to say for a while, which is we're on thin ice. The market has massive destruction underneath the surface. The index is levitated last year, but I think I said to you yesterday, there's a record number of stocks in the Nasdaq that have dropped 50% in the last 12 months. I mean, it's insane what's going on underneath the indexes. In my experience, I say to you, that's always led to a sell-off in the market that's on the big indexes, always. So this time would be different? Okay, maybe, but it always, my whole life has led to selling in the market. So this is why I'm uncomfortable. Risk monitor's red. I'm uncomfortable. So now I have another piece to that puzzle, which is the volatility of volatility. We look at VIX. It's trading in the 24, 26 range. Volatility itself has been elevated and just doesn't seem to get back down to those positive gamma levels. And the longer volatility stays elevated, the closer you get to the fat tails on either side of that bell curve, right? So you could have a rip higher, but with all the things that are out there, you get closer and closer to that implosive move. And so it's just something to consider and to watch. If volatility remains high, that's just a problem. It's just a problem that we have to be aware of. Okay. So anyway, trading posture, looking long, capturing alpha, harvesting that alpha, but willing to short because we're risk monitor red and we're in a negative gamma environment. Okay. Investing posture. So one thing I'm weighing, this year, I'm trying to do things a little bit different, And that is I'm trading around the core. So I didn't sell everything just because we went risk monitor red. The dividend portfolio is basically fully invested almost, right? And those stocks are going up. Everything in our portfolio that's really working, if you look at it, they all touch the commodity market. So we want to keep leaning in this direction. It makes sense. We have an inflation issue. We have the Fed raising rates. These are the stocks that normally do well. We're going to set gold and silver aside for a moment. And please stop telling me, and I don't mean to sound, I mean no offense here, but please stop telling me or posting some, gold guru who's going to tell you that gold has to go down because rates are going up. Okay. That gold guru just is not a student of history. I don't know what to tell you. I mean, there are times when rates go up. There are times when the dollar goes up and gold skyrockets. I mean, there just are. So go do the homework, go see, and let's just stop talking about that. I mean, these guys come out and tell you gold has to go down this year because rates are going up. And was that the same guy that told you gold had to go up last year and the year before because rates were coming down? I mean, if it was that easy to invest in gold, then, we'd all, blah, blah, blah. So it doesn't work like that. It's just a neophyte's approach to, what gold's going to do. Gold is manipulated. Okay. We all know that. Right. So basically following the theory that gold has to go down when rates go up. I mean, so that means gold never goes up. Is that what that means? Right. Because it doesn't go up when rates are coming down. And now it has to go down when rates are going up. So basically gold never goes up, which is not true. We go back and look at the last 20 years and gold's been going up. So, I mean, it's just that analysis is just static analysis. It doesn't help anybody. So all we care about is looking at the chart patterns and figuring out what we're going to do at each level of support and resistance and whether or not we want exposure. And let's just stop trying to be philosophical about it. It's a manipulated market. At some point, it becomes unmanipulated. When that happens, there'll be massive gains in the precious metals. If somebody's uncomfortable with the metals, I beg you not to invest in them. Just because I put money in the metals doesn't mean you should, right? But there's very definitely a powder keg set up in precious metals. I don't know what's going to light it off. So what I'm doing and what I've been stressing, and I hope you guys are picking up what I'm laying down. I've been stressing, do not get over your skis in the space. Don't put too much money there. It's an allocation in a portfolio. My allocation has been in the 2/3 of the allocation for me is in the bullion directly. I'm not even buying the stocks right now, right? We had GDX. That was my only position, and I took it out immediately. The reason for that is the amount of money that we're going to make on these things when they really start to move is going to be enormous, and there's going to be lots of time to put those positions on. I don't have to put them all on where I think the bottom is. What's going to happen is there'll be a breakout, and I'm going to make money in a measured way on my bullion positions, maybe a GDX position. Then there'll be a pullback to test, and if the test works, then I start layering in individual metal positions for a real move in the metal stocks. But I don't do it down here. And I keep saying that, and I hope you guys are hearing what I'm saying. Okay? But every other commodity seems to be starting to touch off and go higher, and that's where we're having our success. And I was doing research yesterday, just combing through data and looking at charts. I don't have nearly enough exposure to the energy space. I mean, that's all I can tell you. These stocks look unbelievable. So the best way to look at it is XOP. And so I had a position on, I took a position off. I really should own this in the ARMR portfolio too, okay? Which doesn't buy individual stocks, but it can buy, and maybe I should own Gush, right? Because that way I get a little extra. This is not 3X, right? I think it's 2X. We all agreed on that. So I can go look at it again, but the trade station's off here. For some reason it says 3X. But it's the same type of a chart pattern, and it'll give us double the performance of XOP. So if we want instead of getting single stock risk, because I don't want to go out there and buy a bunch of individual names, I'd rather just, if I want that type of explosive growth, I could always buy Gush. I think personally XOP is enough. I mean, it's a lot of volatility on its own. So, this thing moves 3 or 4% a day. So do we really need 6 to 8% a day? I don't know. But anyway, so that looks incredible. One of my favorite investment themes when you start to get rolling in energy are the drilling stocks. They can have huge moves off of bases. Now that looks kind of ugly right there. This gap down on HP, which is every single cycle, this is the best drilling company to own. This looks like a shakeout to me, right at the uptrend line, and a recovery. All right. When I listened to this conference call, the most important piece of information coming out of that call is that they increased their capex this year and expect to be getting more rigs ready to roll in order to meet demand. Okay, that's always the time you want to own these things. So capex is going up, getting rigs ready to meet demand. It costs money for them to do that. So margins go down the first half of the year, and that's what bottoms the stocks. The short-term guy says, oh, the margins are going down there. CapEx is up. I don't want to own this thing, right? But the real investor in energy understands they have to do that in order for their rig rates to go up in the back half of the year. And by the time the rig rates go up and rig counts go up, the stock's already out of here. So the time to own the rig stocks is right now, right in these bases. So they're at the top of my list to focus on. There's going to be explosive growth in these names. There's Transocean. Transocean, probably rig, Transocean, Noble Energy. Noble Energy. What am I feel like I'm gonna have to figure out what is the another symbol. I can't remember what it is right now. But anyway, I'll be looking into the rig stocks. You could also look at the service companies, right? Schlumberger is breaking out. I mean, these are perfect cup and handle breakouts. Now, I'm not chasing this here, but I'm sharing this with these chart patterns with you. We own shares of Exxon. That thing broke out like crazy, right? We own the pipelines. I mean, it's my favorite way to play it. We're gonna have capital gains by the end of the year in these things, and we're gonna collect a 6% yield. That's my favorite. That's why we already bought those. Those are the first things we buy. Okay. But I'm going to be looking to build my exposure in the energy space. The go-to and easiest way to do it is XOP. I don't need XLE. That's the big cap. But maybe I do. Look at that pattern. I mean, these things look sick. Okay, so it doesn't mean I'm going to buy them up here, but I'm going to be looking to buy weakness. So let's say the whole market sells off and everything gets whacked. I mean, that's, in my opinion, that's normally what happens. Everything goes down at once. So when you get eventually everything goes down at once. So this is why when I'm risk monitor rent, I don't make a bunch of new investments. But I'm just sharing with you what's at the top of my whiteboard, the top shelf. So if the selling gets bad enough in the market, they're going to drag everything down. They'll drag energy down, right? And when they drag energy down and we go risk monitor green, energy is the first thing we're going to start putting in the portfolio. Or if they drag energy down, we're not even green yet, but we get these energy names right into bases, we might add some names. So energy is definitely the top of my list. I'm seriously considering, and I ask any ARMR insider to share information on why they don't think I should do this. But here's Rio Tinto. We picked it off perfect. We're making money there. BHP is running right here. And so I've been avoiding Valley. And I'm just staring at that pattern saying, why am I avoiding that? If it goes below the low of these bars right in here, I'll get out of it. But I mean, usually it follows the BHP and the Rio. Unless you guys know something I don't, feel free to share that information. But I have my eye on finally pulling the trigger on Valley. There are also the coal stocks look really good to me. Look at Peabody, which had that wicked run here, and that's pulled right back to the support. I think ARLP I've already missed, which is my favorite coal stock. Holy smokes, Alliance just blew out. But Peabody is always always in the mix there. So I got my eye on Peabody. I still have my eye on uranium. Don't think I haven't, I don't want to own this. I do want uranium because energy is working. Uranium's going to work. It's just, I don't like buying uranium in the midst of, Kazakhstan, blah, blah, blah. I can't figure out that risk. And so I'm waiting for this thing to, create a base that I'm comfortable with, and when the dust settles, I can see myself in uranium. Okay. Two more parts to the market I'm going to share with you that, clearly these are the strongest sectors of the market. All right. And do I throw in the towel and eventually buy some financials? I might do that. The ETFs are clearly XLF and KRE. Those are the banks and the financials. You can see them blowing out. I'm not going to chase them in here. But the stocks that look really good to me that can be bought right now really is JP Morgan. There's your first stage up. This is the second stage base. Support at the 50 and the 200 day. That really could be owned right now. And so my go-to is, Goldman Sachs, JP Morgan. Erez already proved to us that Morgan Stanley is the best player in the space. And that's just a nice tight consolidation at the 50-day moving average. I could own those three names and completely cover my financial needs, and I don't know. I find them sexier than, for some reason, I just like to own them more than these insurance stocks. But the insurance stocks are certainly, coming out of their bases as well. So financial, and then let's just round it out with semiconductors. This group is unbelievable compared to the technology space. Tech stocks are getting, whacked, and the semi stocks just don't want to go down. So at the top of my list is still AMAT. I'd love to get AMAT. I mean, I should probably be looking to get AMAT. Microchip. These charts look really good, right? KLA 10 core. Oh no, that's too far away. But you get my point. I'm not a fan of AMD or Nvidia here. These charts look busted to me, and they're the leaders of last year that I think are going to have to go through a different consolidation pattern. Okay. So I'm not looking to add Nvidia, not at this point. I mean, the pattern might change, but not right here. Although I really think I got to add shares of Intel. So I'm looking to add some Intel in here. That's the kind of pattern that kind of intrigues me. So Intel, Microchip, AMAT, those are the names that are at the top of my list. So Mo's asking me, what do you think about the best way to own uranium? I really think it's URA. I really do. I don't want to go out there and I still say that I'm all right. Okay, Mo, you want my answer? Here's my favorite 4 stocks. These are my favorite 4 stocks. URA is my favorite because I don't have to worry about single stock risk and I can own the whole group. And, I'm getting 26% of that index, I think, or 22% is CCJ. So I get a big slug of CCJ, which is, the leader in the space. Okay. I like UU because this is also a rare earth play that people don't quite realize. And I like that chart pattern. Okay. I'm not, this sell off here. This is all because of the news cycle. And that's why I'm not touching these names right now. But let's say they come down, make a double bottom at the 200 day, and we get past the whole Kazakhstan hysteria. That's going to be a great opportunity in those names. NXE, I really like. And I always think DNN is an interesting little idea. Oh, and don't forget LEU. This is a thin stock. It's a little bit crazy, but it's a unique uranium company. It's different than the others. It focuses on the type of uranium that goes into these small reactors, and that's what's being built out. If you're talking about nuclear energy as a green energy, replacing other types of energy, the future of that is small reactors and many small reactors. And this company, that's their niche. And so that's always an interesting idea. So those are my top names in the space. And I can write it into the Slack room for you so you can see them. And then, so I can own my top names, figure out what percentage of the portfolio I want uranium and put those top names in, or I can just own the ETF. It's really up to each of us how we want to play it. Dennis, you're asking me why I say vol is high, but why is VIX so low? VIX is an ETF. It does not reflect the vol that I'm necessarily talking about. It's changing constantly. It's VIX is an ETF. Look at how VIX is put together is all I can say to you. So there's other gauges of volatility that we have to monitor. And those other types of volatility continue at a higher than historical rate, right? So Goldman Sachs is out there again this year talking about how everyone should be selling vol, and it's such a great trade to sell vol. And it's a great trade right up until Volmageddon, right? Until something happens that blows everybody out. It's the visual image is there's a whole bunch of guys out there that are picking up pennies in front of a steamroller, right? That's what's going on right here. But VIX has been elevated for the last month, and it doesn't quite get back down to these historical lows that you would think it would go to. So it's not really a discussion of VXX. It's a discussion of the whole volatility complex. That's what I'm talking about. All right. Any other questions before I go? We all good? All right. Oh, and I guess just that last thought, Stephen, we already kind of hashed it out in the Slack room, but after hours trading means nothing. Okay. So nothing. The only time an after hours price has any meaning is when it's a big enough stock, like a larger cap name, and there's an earnings announcement or there's some piece of news. And so the stock is trading volume in the aftermarket. So if you see weird prices on a stock that you own, but there's no volume trading and you can't find any story, then it's meaningless. Nothing's happening. It's just bids and offers that pop. And when the market closes, the bid and offer goes like this. And so it just doesn't mean anything. Anybody who's trading at the bid and the offer that's that widely spread is making a mistake, and they just don't know it. And there's no volume, particularly on something like the pipelines. There's no, unless there was a piece of news that a pipeline ruptured, and so the stock is down 6% in the aftermarket, that would be real. You see what I'm saying? But if there's no news and you go look at the volume of something trading and you see there's no volume, then you know it doesn't mean anything. It's pointless. Okay. All right, everybody have a great trading day. I'll see you in the live trading room in a few minutes. We'll be looking for that alpha capture long trade first thing this morning. And I'll talk with all of you again at later in the day if there's something worth talking about. The in-game updates only if we're really making changes in the portfolio or something important to share. I am seeing, we haven't even talked about what's going on in the crypto space, but it's getting ugly in the crypto space. And so don't forget, that's always a lead indicator for us. The crypto space is that the animal spirits, right? The risk on guys, and they're getting crushed. And so that's another layered in piece to the negative bear puzzle. So stay nimble out there, guys. Stay nimble. Don't shoot till you see the whites of their eyes. All right. Take care.